You know what, guys? At this point, we'll never be in a recession because the government will just keep redefining what a recession is. We'll just identify as being rich even when we're dead broke. I mean, everybody's feeling it, right? Now, they say recessions don't get officially announced until way after every American feels it in their heart and in their pocket. But what do you guys think? But seriously though, most economists and banks are expecting the official recession to happen later this year or even next year. Check this out.
But the one component of the ISM that we spent a lot of time talking about was employment. It continues to decline. You've only seen it at these levels when the Fed has been cutting rates. So either this is something brand new or the markets, the data in the markets, the economy is telling us we're going to see slowdown.
So you're in the recession and the lower bond yields camp.
Absolutely.
Okay, the 10-year level, next move from here. Well, maybe I shouldn't ask you next move because at this point, who knows? But what's the ultimate move, do you think, in the next 12 months or so?
We see the U.S. in recession somewhere around year end. We see the Fed cutting rates before then. We think they'll have to go down to 2.5% to 3%. We see the yield curve pretty steep. We can see the entire yield curve, say 6 to 9 months from now, 3%.
Now, the question that I have, if applicable, is how long will the recession last? The one in '08, it took 5 to 10 years to be fixed. I know because tech companies only started hiring in 2013 and much more aggressively in 2015. Recession, I know, it's a word that sends shivers down our spines. The debate about whether we're heading for one has been going on for the past year or so. Some people believe that the declining real GDP figures in the first half of 2022, they were proof of the US economy already heading into a recession. But when the economy showed signs of moderate growth in the second half of the year and job figures remained relatively strong, the White House and the Federal Reserve said, nope, it wasn't a recession. But hey, it's all about that inverted yield curve, huh? It's the bond market's canary in the gold mine. Y'all know what I'm saying, right? So basically, it's when the short-term bonds offer higher yields than long-term. See, normally, long-term bonds offer higher yields than the shorter-term ones. And since investors are tying up their money for a longer period, they should be rewarded normally. But when the relationship flips, when the long-term bonds actually drop below shorter-term interest rates, then we have what is called an inverted yield curve. And this isn't something that we should be ignoring. History shows that an inverted yield curve has reliably signaled an impending recession. Matter of fact, the Fed of San Francisco checked this already. The connection between the yield curve inversions and the United States recessions ever since 1955. Yield curve inversions have reliably foreshadowed all 10 recessions the economy has encountered during that period. So, even though some may dismiss it, the Fed, it has proven itself time and time again as a very remarkable forecasting record. The bond market is sending us a message, and we should definitely not ignore it. It's pretty logical if you think about it. Bond markets, like all financial markets, they're forward-looking. When the Federal Reserve raises interest rates, as it's currently doing, bond investors anticipate an upcoming economic correction that will eventually lead to lower interest rates. To capitalize on this prediction, investors end up buying bonds, locking in high yield rates before the decline, and expecting capital gains on their bond holdings when yields fall. Now, this buying behavior, it prevents longer-term yields from rising as much as the short-term rates directly under the Fed's control. Now, we've all heard the recession warning over the past 9 months or so, particularly since the yield curve first inverted in October 2022. Now, initially, the rate on 3-month Treasury paper and the 10-year bond were the same, both sitting at 4.1%. By mid-January 2023, the 3-month rate rose to 4.7%, while the 10-year yield dipped to 3.4%, resulting in an inversion of 1.3 percentage points. As of mid-July, the rate stood at 5.4 and 3.8%, so it was definitely a steeper inversion than in January. Now, based on these movements, the Federal Reserve of Cleveland calculated the chances of a recession, with the possibility raising from 54% in December to over 63% in January and reaching almost 78% in June. Now, what this yield curve isn't as good at predicting is the precise timing of the coming recession. Now, when you check the historical data, the time between the first inversion and the actual onset of a recession, it varies. So we can't really place a reliable average. Now, the longest lag ever recorded was a staggering 22 months, occurring from the initial inversion in January 2006 to the Great Recession's onset in late 2007. Now, on the other hand, the shortest lag on record was a mere 6 months, from the initial inversion in August August 2019 to the recession start in February 2020. This was the timing of the C-19 pandemic, lockdowns, and quarantine, so those probably influenced this unusually short lag. But man, guys, I just can't believe that we lived through this pandemic that shut down the entire world. It still kind of weirds me out today just to think about that initial news that we got. Now, going back to this recession talk, right? Now, if we were to follow the longest lag as a guide of the current situation, then technically the next recession would wait until August 2024. Now, I can imagine what that would mean for President Biden's presidential campaign, but yeah, we never know. Now, if we use the shortest lag as a guide, then we're already overdue, like what a lot of you guys have been saying in the comments. In between the shortest and the longest lags, the average would place the start of the recession in the final quarter of this year, which pretty much aligns with the other economic indicators indicating a weakening economy. Now, I know forecasting a recession is never a sure thing, but the overall direction of this pretty big indicator seems to be pretty clear. Plus the other economic indicators, of course, we got to look at everything. I mean, nearly all signs are pointing to an impending economic correction, even if the 2-week quarters at the beginning of 2022 were a false signal, according to the Fed. But what I do know for sure, though, is that we're going to be watching this thing very closely, and I'm going to make sure to keep you guys updated. I'm going to give you guys all of the developments when anything happens. Now, if you guys are appreciating the financial information and finding our content helpful, please consider dropping a quick like for the video and also subscribe to the channel if you haven't already. Your support means a ton, and it also helps the channel grow. Don't forget to hit the notification bell as well. We're working super hard to hit that 500K subscriber mark every single day, guys. Our very own financial freedom fam right here on YouTube. And hey, I just want to thank you guys so much for always being a part of this journey. I'm very excited to actually share more insights with you guys in the future. But hey, we are not done yet. A US recession is coming this year. This is according to HSBC Asset Management's warning. And Europe, they're set to follow in 2024. Now, according to their mid-year outlook, recession warnings are flashing red for many different economies. And there's a high risk of a downturn in the United States by the fourth quarter, followed by a European recession in 2024. But here's a twist. While some parts of the economy are holding up, the overall balance of risk points to trouble ahead. Now, we're already in a mild profit recession, and corporate defaults are creeping up too. Now, the good news is that they expect high inflation to take a step back, which could lead to interest rate cuts by the Fed before the end of 2023. The European Central Bank and the Bank of England might follow suit next year. But that's just the most optimistic investors talking. Fingers crossed, guys. Now, here's what it gets really interesting. The recession might not be a total plunging of inflationary pressures, so brace yourselves for somewhat higher inflation and also interest rates in developed economies down the line. And so this is why HSBC Asset Management believes the treasury curve is looking pretty appealing. They see value in European bonds right now. So, hey, you guys might want to look into that for your next investment options. At least that's according to HSBC. So, is a recession on the horizon or not? Well, interest rates are soaring, and the classic recession indicator with short-term rates being higher than the long-term rates is blinking. But guess what? The economy is still chugging along, and if a recession is coming, it might take a lot longer than we expected. The first half of 2024 is looking more likely for a downturn and maybe even later. Why the delay? Well, unlike the past, the Federal Reserve's steep rate hikes, they're not putting the brakes on the economy just yet. Demand for homes and for cars is on the rise. And service businesses, they're doing well. Consumers seem to be holding up pretty well, sitting on a stash of extra savings from the pandemic. But growth will slow for the foreseeable future, and we might see a couple more interest rate hikes along the way. Inflation is still a concern, and only a recession might make the Fed ease up. So while there's no immediate sign of a downturn, we can't let our guard down just yet. Just keep an eye on that yield curve inversion. It started 8 months ago, so we might need to wait until the year end before the storm clouds gather. By the way, if you own a home, make sure your home is protected. Be sure to get your free home warranty quote. There's a link in the description down below of this video. Now, survey says that the economists see a 59% chance of a recession by July 2024. The US economy has so far avoided what most experts at this time last year assumed to be an inevitable 2003 recession. Economists, however, they still think a downturn is likely on the horizon. Experts put the odds of a recession between now and July 2024 at 59%, a roughly 3 in 5 chance. So probable odds that an economic environment featuring job loss, slower business growth, and a tough stock market are on the horizon. Illustrating those odds even more, most respondents, sitting at 78%, they indicated that the percentage chance of a recession was greater than 1 in 2, while 28% said that the odds were more like 70% or higher. Just 22% said that the odds were at 50% or lower. Now, they're crossing their fingers for the projected recession to not be as severe as the C-19 pandemic and the Great Recession. Both downturns pushed unemployment up to double-digit levels. And you know what that means, guys. It's time to protect ourselves. By the way, for the best way to invest in gold, check out the links in the description down below of this video. Now, recessions are an aspect of the business cycle that's as inevitable as rain is to weather. It doesn't take a weather reporter to know that at some point in time, it's going to rain. There's going to be a storm. But as far as downturns go, this could be the toughest to predict since, we're in the aftermath of the post-pandemic inflationary burst. The Federal Reserve has raised interest rates to a level not seen since 2007 and at a pace not matched since the 1980s. Typically, the Fed has never been able to raise interest rates this far and this fast without prompting a downdraft in the business cycle. Historically, the Fed has never been able to defeat inflation without a recession. But really what's surprising to economists is that the downturn hasn't yet shown up to crash the economy's party. To be sure, the economy has slowed from the economy's grand reopening after the pre-pandemic induced lockdowns. And banks have also tightened up lending standards in the wake of the 3 major bank failures earlier this year. Yet, consumers have continued spending their money, stunting on the gram, flexing, buying cars, watches, expensive handbags, red-bottom shoes, and the labor market is still chugging along. Now, I personally think that the US economy isn't out of the recessionary woods just yet. Rather, it just likely hasn't fully caught up with the tightening in the pipeline so far. Most of the indicators used by the National Bureau of Economic Research to decide whether we are in a recession, they still point to a very strong economy even with the recent financial volatility. But they still want to keep tightening monetary policy even further this year. So that could lead to the economy weakening by either late this year or early next year. It's bound to happen. Some people out there, they seem to think that we can defy economic gravity by just simply printing money like crazy and never facing a bust. But let me tell you guys, the signs are pointing towards an imminent recession that could be pretty darn severe, possibly rivaling the Great Financial Crisis and even the Great Depression. The Federal Reserve and analysts from Goldman Sachs, they are diminishing the yield curve inversion, but historical data shows that this kind of deep inversion, they have often preceded major recessions. This time, the yield curve is the steepest that it's been since 1981, indicating the highest likelihood of a recession in over 40 years. So the notion that it's different this time and we can just ignore the laws of economics, they don't hold up. I don't know who said it, but this made a lot of sense to me. If the American people ever allow private banks to control the issue of their currency, first by inflation, then by deflation, the banks and corporations that will grow up around them, they will deprive the people of all of the property until their children wake up homeless. What do you guys think about that? By the way, if you guys made it this far in the video, be sure to drop a like for the video. Also consider subscribing, and I'm gonna see you on the next one.